Thanks for tuning into this conversation with Nitin Rakesh of Mphasis. As much as I want to talk about the quarter and what Mphasis is doing, Nitin, thank you for joining in. But I want to start off with your honest assessment of what's happening in the space, because your peer sets that have come out thus far, I have seen chalk and cheese both. I would love to understand, I'll talk about Mphasis, but just love to understand, how do you see the landscape right now for an IT services company?
So Neeraj, there is no one straight answer I can give you, but I'll give you the nuances that you should think about when you look at performance, right? Not to talk too much about where we were and where we are and where we came from, but at the end, it's important to look at the trajectory of the business, both from a macro standpoint, but more importantly, from the underlying shifts in the tech trends. We've obviously seen 23 being a difficult year for pretty much the entire industry, especially folks oriented towards BFS, as well as discretionary spends, transformation players, app dev players. So I think we saw something like that play out for us as well. But we called a bottom to that trend in the December 23 quarter, and there were some early signs that we will see a pickup in new tech-led deals. The appetite for applying transformation to operations will potentially lead the next wave of recovery. The spend that comes back or is slightly coming back now and will probably come back, in terms of a higher recovery over the next couple of quarters, will not be the same shape and form that it was in 2021 or 22. So I think that thesis is playing out. We've seen mixed numbers coming out, but that's predominantly driven by either each company's own internal business portfolio, verticals, geographies, but more importantly, also driven by how they might be placed as the spend shifts from where it used to be, which was obviously run the business and digital transformation and data and cloud, to where it's headed, which is a combination of all of those things, but now infused with AI and Gen AI. So I think the best way to think about a company's performance is the reflection of their investments in embracing this pivot, their ability to protect their business by infusing it with AI. And of course, there are some pockets of businesses which will be very highly susceptible to disruption, especially around volume reduction, right? For example, if there is a large IT operations shop, and even if you're in a managed services business, you're still pricing it by widget or by ticket or by incident or by call in the contact center business, and so on. So I think the susceptibility of volume reduction, value creation for customers is very high there, especially as we stand today. We've seen adoption of those kind of platforms starting to pick up. So I think the reason you're calling it chalk and cheese is because of some of those dynamics. And of course, going forward, the divergence might even actually get sharper, and you will see redistribution of wallet share and market share pretty rapidly over the next 12 to 24 months.
Wow. So Nitin, when I was looking at your quarter as well, right, the new TCV signings have seen a buyback. It's a sharp, nearly 70 or 80% quarter-on-quarter uptick. So that is great for you. But so tie that in with what you just said and explain that could it happen that your deal wins for the near term, your or the industry's deal wins for the near term, because of the impact that new Gen and Gen AI deal might have on the run the business size of the deals that you've traditionally used to win, that could these be very lumpy, and could this continue for a few quarters? And also throw some light on your deal wins, and then we'll come to the revenue and the margin numbers.
Sure. Great question, Neeraj. I think if you think about, large deals by definition are lumpy. But part of the reason why over the last couple of quarters we had a little bit more muted TCV number was because clients weren't really ready to commit to a large program, given the uncertainty. And in their mind, uncertainty wasn't just coming out of the macro. And I've been trying to kind of belabor that point over the last couple of quarters. The uncertainty is also driven by where should my spend move? How do I reallocate my strategic investments in tech? Because tech is now embracing every part of my business, from operations to marketing to customer experience to, of course, my entire tech stack. So from that perspective, I think there is a little bit more emerging clarity. We've seen a pickup in TCV conversion purely driven by the fact that we were able to bundle transformation thesis, combined with efficiency. So we are actually calling that premise savings-led transformation. And not only have we seen an uptick in TCV, as you talked about, of 70+%, we've also seen a pretty massive jump in our overall pipeline volume at 17%, led primarily by these AI-infused large transformation and savings-led deals. So the narrative has moved on from being purely cost-led to actually, or cost takeout, to being actually transformation-led with savings as a great byproduct. And at least from our standpoint, our large deal pipeline is up very substantially. Conversion obviously happened. We had 3 large deals in Q1, one of them over 100 million, pure transformation deal that applies transformation while giving customers the savings. Great welcomes trend and a sign that customers are now ready to at least not only have a conversation, but start thinking about how do they derive value from what they've been experimenting with for the last 18 months since ChatGPT was launched.
Wow. And now combine this with the nature of, or the vertical-wise performance that you showed, because there was strength in BFS and insurance, which was great. I mean, Mphasis showed that, you've shown that, maybe one other company showed that. Not everybody did, but at least the ones who got a large BFS performance. But the fact that your revenue numbers relative to what was estimated were a bit of a miss. So explain that piece now to us.
Yeah, I think again, in our business, there's always, at least in our portfolio, the nuance always was direct versus DXC. So I think our direct business has actually performed well. We've had a second sequential growth quarter. Not as strong as the last quarter was, but we were probably an exception last quarter when we showed sequential growth coming out of a muted 2023 for the industry. The second metric to note for us is there were 2 big headwind items for us last year. One was the BFS business, which obviously we have a higher percentage. BFSI put together about 60% of our revenue. We've again seen a second quarter of sequential growth and pretty well established that we called the bottom in December. We grew over 2% in March, and we grew over 1% sequentially on top of the 2% growth in June. Second headwind for us was some of the discretionary macro trends that we were talking about with our top clients, especially top 10 is a higher percentage for us. And we've seen good pickup in top 10 clients in terms of revenue and, of course, pipeline as well. I think pipeline has been very, very robust, broad-based. So I think those 2 big factors are helping drive revenue momentum and growth. Of course, the miss was partly led by the decline in DXC business, which in a way, is hard to predict given just the nature of the relationship and portfolios. But more importantly, I think we are very enthused by the fact that we led the BFS recovery. Some folks in the industry followed through this quarter. We've continued for that trajectory. We called for banking to lead our growth coming out of the December quarter, and we've established 2 quarters of that. And we do think that business will actually continue to lead us into growth over the next couple of quarters as well. The only one thing that I haven't yet baked into the outlook is recovery in mortgage, because that itself is 6-7% of our revenue, because that's very hard to predict from a macro standpoint. So I think all of this that we're talking about really is a micro view. Top 10 accounts grew 1.2% sequentially. Top 5 grew, next 5 grew as well, and clients 21 to 30 actually grew 3.5% sequentially. New clients grew 22%, YOY in terms of revenue. So I think it's barring that hotspot, a couple of hotspots in the business that we will obviously have to continue to work towards. We are actually fairly pleased with the broad basing of that growth, and both from a pipeline and a TCV and a revenue perspective.
Got it. So the flattish performance in North America relative to what some of the others have shown, because everybody's shown BFS and NA both. In your case, BFS has picked up, NA hasn't. Is that got to do with your key client, I mean, DXC as well? Or are there other reasons and you expect a pickup in the quarters to come?
It's predominantly linked to some of that segment performance. Also, I think this quarter for us, very pleased that Europe has grown
exactly
10+% YOY. I think it was about time we had been seeing that build up, but then we are pleased to deliver that kind of growth in the EMEA business. Again, more work to do. It's a little more nuanced, in terms of the geo and the mix of the business there. But again, pleased with that. I think the pipeline growth and the TCV growth in Europe, in Canada, has also been pretty strong. Even of course, US banking home market recovery in top 10 pipeline and revenue recovery in BFS are all very, very core to our growth going forward.
Got it. Nitin, one final question. You've worn the hat of an investor as well. This space is changing so rapidly, and you mentioned that the nuance of the deal wins are also changing. How does one go out and think of an IT services firm right now at a point of time when there is an ERD pocket, there is a products company, and services businesses are quote unquote in the minds of people taking a hit because of AI? Because the contra view is that not everybody will be an AI leader and everybody will need an IT services firm to help them in their AI journey. So how do you therefore think of business and valuation from a 3-year perspective?
So Neeraj, I think you almost answered that question that you raised.
Okay.
You don't have to be everything to everybody. You pick your areas of specialization, not just in verticals. That's important, but actually what's getting more important is picking areas of expertise in applying that tech leadership, making sure that the tech pivots don't catch you by surprise, making early investments in the ability to go to the customer with a thought leadership, the ability to then bring not just people but also architecture, design skills, combine them with engineering skills, and of course, domain becomes the fourth leg of that stool. I think that's the way we think that value will be created. We are also moving into an era where you will necessarily not see people running software; it'll be software running software. If you're part of the equation and you have that ability to orchestrate the software that runs the software, then I think there's a lot of volume and market share to be gained, and of course, valuation multiples will reflect that as well. So in a way, staying away from tech obsolescence is the number one thing that keeps me awake. We want to make sure that we are never playing catch up in our chosen areas of tech leadership.
Wish you all the best for that. I'm sure it's a difficult road, but all the best, Nitin, and thanks so much for taking the time out and speaking to us today.
Absolutely, Neeraj. It's difficult, and hence anything worth doing is difficult, and it's exciting as well at the same time.
Exactly. Well put. Thanks, Nitin. Thanks for the times.
Thank you.
All right, viewers, thanks for tuning in.